Yes, we are live again from CITIC CLSA India Forum, and joining me is India economist Nikhil Gupta. Nikhil, thank you very much for joining us on ET Now. We are in interesting times globally as well and domestically. From global point of view, everyone is eyeing what the Fed is going to do in December, and from the domestic point of view, the inflation is so low that now the debate is going to be whether 25 basis point or 50 basis point in December. What's your take?
Right. Thank you very much, Sajid, for having me on the show. So, since June, since when we had a 50 bp rate cut by the RBI, which was unexpected in June, we have been holding this forecast that there may still be a room of another 25 to 50 bips over the remainder of this year. So, we were clear that there is not going to be any rate cut definitely in August, and even in October, at that time our forecast was no rate cut in October, and we were maintaining that there is a possibility for December rate cut, primarily because we thought inflation could be lower than what we had expected. And the RBI revised its forecasts for inflation lower last time, then we had the GST rate cut, and then everyone revised their forecast lower according to that. And that was one of the primary reasons why we believed that December is going to be a live policy in terms of rate cut, which is still our base case. We still continue to believe that we will have a 25 bp rate cut in December. I understand that after 0.3% inflation reading that we got last week, the noise or the probability of a 50 bps rate cut has definitely gone up, but that is not our base case. We believe there could be 50 bps rate cut, but divided in two policies, December and February. I think it's better to move cautiously. But we believe 5% after 50 bp rate cut, 5% will be the kind of terminal rate in this cycle.
In this cycle means till March 2026?
Yes, in fact, we are not penciling in, as of now, we are not penciling in any rate cut for CY 26.
Okay.
So, after February, probably for the remainder of calendar year 26.
We'll go at,
we'll stay at
same.
So prolonged
but why do you say so that a rate cut beyond 25%, 25 basis points will be pushed to February? There's also the chatter which is there, right? That okay, we need to push the growth there. Inflation is in control. We have this opportunity now to push growth because not only this year's inflation, but maybe the first half of next year's inflation will be revised downwards, given the kind of what we have seen, the trajectory for inflation. So how do you do it? And for next year, anyways, the growth target is which has been penciled by all economists, it's much lower than this year what FY 26 what we're going to end with. So why do you say so?
All right. So first, if you look at growth numbers at this point in time, we had real growth of 7.8% in Q1, and we expect it to be around 7.5 to 8% in the Q2 as well, for which we get the number this month end. The RBI is expecting it at 7%. So the growth has been better. We believe the growth in the September quarter is better than what the RBI projected, and inflation is definitely much lower than what they projected. So that is why we believe that there will be a rate cut. Why 25? Because while inflation is much lower, growth is going to be very, very strong in the first half. Now you can always talk about nominal growth rate, which we know is much weaker, and there is a role of deflator because of which real growth is much higher. But I think at this point in time, I would recommend, or I would suggest the RBI to go in steps rather than taking a big leap forward. They have already done 150 bp rate cut in June, and the guidance that probably this is it, we may be very careful in cutting more rate cuts. I think that at that point in time it worked not in favor of monetary easing. I think it would be better if this time also, rather than doing 15 one go and then telling the market probably we are done, it would be more wiser if we go in steps and keep some room open for probably another rate cuts.
This is chatter that we need to push our nominal rate to about 10%.
Right.
How do you do that if you are not going to put the stimulus? Because the government doesn't have much of a fiscal room after the GST cut which has happened. They're going to stick with the fiscal glide path which has been articulated. At the same time, you have the states and elections where there are a lot of subsidies being rolled out. So there is a pressure which will be there in the states as well to push consumption beyond a point there. So the only way to do is by RBI, right?
You can say that, but then RBI also has its limits. You would be aware that there is this entire real interest rate, which is one of the way they look at where my interest rate should be. And at this point in time, our forecast and even the RBI's forecast is that we'll be back to closer to 4% headline inflation by the middle of next year.
Okay.
So when they talk about real interest rates, they look at the current interest rates and inflation expectation, let's say 3 to 4 quarters down the line, generally about a year ahead. Based on that, the real interest rate comes out, if I'm expecting it to be closer to 4%, then my real interest rate is anywhere between 1–1.5% at this point in time. I think that is what they're okay with. They would not want it to be closer to 2% or higher than 2%, which will be too tight, and they will not want it to be below 1%.
Okay.
That is why I'm saying 50 bips rate cut is the total rate cut that we are expecting from here on. As far as nominal growth is concerned, yes, we are expecting it to be much weaker, 8–8.5% this year. The government, of course, has done a lot of, has taken a lot of steps. First, at the beginning of this year, they announced much more exemptions in income tax, personal income tax rates, and then GST was announced in August and then implemented in September. So I think we need to give them and ourselves some time and see how these measures actually work out in terms of pushing consumption, spending, or growth higher.
So so you started the year with 1 lakh crore government tax rate cut, then you 50 basis points coming from RBI.
100 in total actually.
100 in total, and then you have another 2 lakh crores worth of GST which is coming in. Are you seeing the impact of GST cut in consumption? So
post Diwali, I mean, I think it's still too early to find out what is the total impact going to be like, because post Diwali we know data has been really good, but that data is not, I would not take it on its face value, because there are few factors because of which the data has been good. So we know GST rate cut was announced by Prime Minister on the Independence Day. And since then it was implemented actually on 22nd September. So we had almost 5 weeks period when probably consumers were sitting on the sidelines waiting for the rate cuts to happen. So whatever we are seeing post September rate cut to the run up into the run up to Diwali, I think it also includes a portion of pent up demand that was there because of probably some slower spending or some postponement that happened during those 5-week period. We have no clue how much was that, and that is why, rather than just looking at how the growth has been in the last 5 weeks or 6 weeks, I think it's better to wait for a quarter. Let this December quarter pass out. I think March quarter, when we'll get the data, then we'll have a better understanding of how much impactful these policies have been.
Yeah, you're penciling in 7.5% for Q2, if I'm not wrong.
7.5%
GDP,
real GDP growth,
growth.
Yes.
And that's based on the consumption, but 5 weeks of no consumption, despite that you're penciling in 7.5%.
Yes, because so again, real GDP, when we estimate real GDP, almost about 40–45% of all the sub-components, we get data in nominal terms, and then we use the deflator to arrive at real GDP, right? Our calculation suggests that deflator will be probably less than 0.5% in Q2, which was 1% in Q1. So when we talk about nominal growth, for which we actually get data and then use deflator to arrive at real, we are expecting nominal growth to be actually weaker in Q2. So it was 8.8% in Q1. We are saying it could be closer to 8% as well in the second quarter. Because the deflator is also falling. Even if deflator is 0.5%, with 8% nominal growth, you can get 7.5% real GDP growth. So deflator plays a very important role.
And how does it play out in Q3 then?
Yes, so that is what we all are waiting, but we got data for October last week for CPI and WY both. Again,
were you surprised by the inflation number?
I was more, I mean, we were expecting close to 0.5–0.6% inflation, turned out to be 0.3%, 0.25% to be precise. WPI turned out to be minus 1.1% again, which was even more surprising. And I'm sure you would know, from the deflator perspective, WPI has a much bigger role than CPI. So I'm worried, because we are expecting some improvement or recovery in deflator going into the second half of this fiscal year, which means Q3, Q4. But we have got minus 1% on WPI, minus 1.1 for October. We need to see how November and December plays out, but there is high probability vis-a-vis a month ago that deflator may still remain very weak in Q3.
Negative, or at least close to zero or something.
Probably. we'll have to revise that data and we'll have to look at what could happen in November and December, because we know there was this exceptional GST rate cut that affected October number. But we also need to be very clear about what was the contribution of food items or the non-GST items.
Especially vegetables, which have been much lower.
Exactly, and that is out of GST. Right?
Yeah.
So we need to be very clear about what was the contribution of GST in this lower headline inflation, what was the other factors, food items, which are much more volatile.
Yeah.
And also slightly going forward, we are getting too much low inflation this past few months, October, November, September. Next, June, July, August, September, October, November, we may see very low base effect, which may push inflation very high.
Okay.
But again, as a policymaker, I think everybody will be taking out the moving averages and they will be smoothing out these headline numbers to make policy decisions.
So what is the kind of growth you're looking at for Q3?
In real or nominal?
In
nominal, at this point in time, we are close to 8.5%. Okay. So the full year as well, we are 8 to 8, and in fact 8.4% to be precise for full year. And real, we are 7% full year.
Full year.
We have close to 8% in the first half and close to 6% in the second half. So we are expecting deceleration, partly because of the recovery in deflator, because nominal growth is expected to be the same. Because deflator, we are expecting to pick up that impact on real, the positive impact that was there.
No, it's interesting, when I speak to equity analysts from consumption side, they are very apprehensive whether this consumption boost which they've seen in the last 6 months or 8 months, is going to sustain going forward. In a normal parlance, some would have argued that this is the boost that everyone is looking at. We're looking at 3-4 lakh crores of boost coming into the economy, into the consumer's hand actually. Right. Not even the government pumping in money; it's the consumer's hand which is coming in. But where it's not turning into a consumption, where is it going? Where is the money going?
So, I first of all do not fall into the camp which believes that GST cuts have led to 3 or 4 lakh crore worth of additional money.
Between the tax cuts, the 50 basis point, 100 basis rate cut, and now GST, all the included. Money in the hands of consumer has gone up, right?
Definitely. So there you're right. Not only that, I can give you another point. All the income transfers that the states have been doing, even then, there are some concerns of consumption spending growth because income growth has not been very strong. You must have seen salary and wages of the listed companies that is coming out. In real terms, it is now only about 1 to 2% in the last couple of quarters, right? So there the point is, despite all these efforts or policies from the states, from the center as well as the RBI, we are still not very sure. First of all, we do not have very real-time basis data to understand whether there has been such improvement, but we are not very sure if this has created a reversal in the weak consumption growth that we had, right? Which means, had these measures not happened, probably things would have been even worse. Right? We have no clue of finding out what would have been the counter scenario. But if things have not improved, despite all this step, we can kind of a little bit more sure that things would have been worse without this support. Second, all these things take time to play out into the economy, right? Income tax cuts happened in February, and I think after that almost all the economists were aware that income tax collection or income tax growth is going to be weaker than what the government was projecting, and at least we were definitely expecting it to be weaker. GST cuts have come during the year, so it is very much likely that total tax receipts of the government will be lower than what they budgeted. Because first there was some pressure from the personal income taxes, now there will be pressure from the GST tax cuts as well. A part of these tax shortfall will be made up by the RBI dividends, which turned out to be much higher than what the government budgeted at the beginning of the year. So one way why all these stimulus have not contributed too much to GDP growth or consumption growth overall is because while consumers have got more money, our understanding is government taxes or government total receipts will be lower than what they budgeted. We also believe that government will not be changing its fiscal deficit targets, which means if there is a shortfall in their receipts, there will be a corresponding cut in their spending. So on one hand, they have given more money to the consumers who will definitely be spending more than otherwise, and they will be contributing positively to higher GDP growth. On the other hand, the government, because they will be spending less now to meet their fiscal deficits, they will be offsetting a part of that positive contribution from the consumer segment. right? So on net basis, from the GDP perspective, private final consumption expenditure growth, you would revise it upwards based on this, but government final consumption expenditure may be revised downwards, which is what we have done. And that is what, according to our calculations, which we have put out, because of GST cuts, including the multiplier impact and including all these factors, which would be netting off some of the positive gains from the consumer, our calculation suggests the positive boost to real GDP growth on an annual basis is not more than 35 to 40 bips.
I think the street was looking at 50 bips, right? Or 50 to 75
Depends
bips.
on who you ask.
Yeah.
But
you know, one of the arguments which was made by the government when they made the GST cut was the kind of the impact multiplier effect that may come into, and as a result of which they will, you know, even though they have foregone some of the GST revenue, it may be compensated by volumes which is there. Do you think the volumes will not come in?
As an outsider, it's a very, very difficult exercise for me to do, because I'm sure you would know when the government announced the GST cuts, they told us only one number, which was a net loss to the exchequer, which they told us about 45,000 crore or something. Unfortunately, we did not have any more details to find out what do they mean by net losses, and second, how did they arrive at this 45,000 crores. So that created a lot of confusion, and every analyst was left on its own to do the calculation and to make sense of those numbers. What we did was what we thought was the best alternative. Instead of taking that 45,000 and trying to make sense around it, we did our own calculations of what could be the potential loss to the government because of GST cuts. So I'm sure you will remember when the personal income tax exemptions were changed in February,
1 lakh
the government told us 1 lakh crore. So we tried to find a corresponding number to 1 lakh crore, because we don't think 45,000 crore is corresponding to 1 lakh crore. So our number turns out to be somewhere like 1.2, 1.3 trillion rupees, corresponding to 1 lakh crore. And then that is the gross money that they have given to the consumers because of GST cuts. Now, of course, there are few adjustments that we need to make. As I told you, the government spending will be lower, so we need to adjust that. Then we also know import intensity of consumption is about 20% in India, which means if consumption goes up by 100 rupees, imports tend to go up by 20 rupees. So, and imports are a drag on GDP growth. And then of course we need to convert from nominal to real. So when we did all these calculations, as I told you, the positive impact, net positive impact, was turning out to be, let's say, 35 bips, not more than that for us.
My final question to you is on the commodity side, which is gold. The impact of gold on inflation and your exports, or the balance of trade or balance of payment which is there. How do you look at that as an economist?
All right. So on inflation, definitely we have seen gold contributing significantly to CPI. In fact, if I remember correctly, gold accounts for almost 1% weight in total CPI, and it grew up by almost 40-45% in the last 1 year YoY basis, which means it alone is contributing 40-45 bips to the headline CPI. Despite that, we have the headline inflation of 0.3%. Right? So yes, that is something we need to be aware of, and that's why the nuances or much more detailed analysis of this CPI needs to be done. What is the contribution of GST related items? What is the contribution of non-GST related items? You asked the impact of gold on trade, balance of trade, or the external sector. I think over the last 11-12 years, I mean, the last problem that we faced, the last episode we had was in 2012-2013, when gold imports increased to about 1,000 tons a year, and they were contributing as much as $50-55 billion per annum. The government had to put in physical restrictions to reduce gold imports, and thus to reduce. And you had
the sovereign bonds.
Absolutely. So we came out with a lot of things. But now, basis what we have seen over the last 10 to 12 years, including the last few quarters or the last few months of this year, gold imports have stabilized at 600 to 700 tons per annum. We have not seen, if I remember correctly, any year more than 700 tons of gold imports over the last 10
That's
to 12
the volume
years.
Part of it. But in value terms, gold
yes,
doubled.
Because the gold prices have gone up by 40-45%. Even then, what we have actually seen, we have seen gold volume imports going down rather than the total value of imports going up. This is what we have seen in the last few months. Going by that, we do not believe, again, my understanding is that when gold prices go up, people in India do not have a target in terms of I want to buy this much tons of gold or this much grams of gold. Instead, we have a target in terms of I want to spend this much money on gold. Now, if the prices of gold is going up, it means I'll be buying smaller quantity of gold because the prices have gone up. That is why I believe that it would not have any concerns on the external sector from the gold import side. So far it has played out. Things may change going forward, but as of now, I am not concerned about our external situation or current account deficit, be it because of gold prices or any other thing. So we are comfortable.
It was a pleasure talking to you and get your thoughts on not just the inflation but also gold and GDP. Thank you very much for joining us on ET Now.
Thank you very much.
Thank you.